Hello everyone, welcome to EPK Capital's daily brief video. In this series we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. When it comes to Indian pharma giants making waves globally, one name consistently stands out: Reddy's Laboratories. But beneath the surface of this multinational powerhouse lies a complex story of growth, challenges, and regulatory hurdles. Today, we're dissecting everything you need to know about Dr. Reddy's stock, from its impressive financials to recent controversies that have investors on edge. Let's dive deep into ticker DRREDDY and see if this pharma heavyweight still has what it takes to deliver healthy returns. The company and its promoters. Dr. Reddy's Laboratories isn't just another pharmaceutical company. It's a global force founded in 1984 by Dr. Kalam N.G. Reddy in Hyderabad, India. Today, the company serves over 800 million patients worldwide across 76 countries, specializing in generics, active pharmaceutical ingredients, and cutting-edge biosimilars. The current leadership structure underwent significant changes recently. As of September 2025, promoters Satish Reddy Kalam and G.V. Prasad transferred a combined 20.58% stake to their respective family trusts, the VSD Family Trust and GVP Family Trust, as part of succession planning. Despite these individual changes, the aggregate promoter group holding remains steady at 26.64%. The company is currently led by CEO Erez Israeli, with a robust management team focused on global expansion and innovation. 10-year financial analysis. Let's crunch the numbers that really matter. Dr. Reddy's has shown impressive growth over the past decade. Revenue growth. Total revenues have climbed consistently from 18,972 crore rupees in FY 2021 to 32,554 rupees crores in FY 2025. That's a compound annual growth rate of about 17%. Profitability. Net profit margins have been volatile but generally strong, jumping from 10.1% in FY 2022 to 19.9% in FY 2024. For FY 2025, net income stood at 5,655 crore rupees, representing solid profitability. Debt position. Here's where it gets interesting. Reddy's maintains an exceptionally strong balance sheet with virtually zero debt. The debt-to-equity ratio has consistently been 0.0, making it one of the most financially stable pharma companies. What does this mean in simple terms? Dr. Reddy's is growing fast, making good profits, and doing it without borrowing heavily, a rare combination in today's corporate world. Stock chart, technical analysis. From a technical perspective, Dr. Reddy's stock tells a mixed story. Currently trading around 1,321 rupees, the stock has shown resilience but faces some headwinds. Key support and resistance. Support levels sit around 1,244 rupees, pivot point, while resistance is emerging near 1,349 rupees. The stock recently crossed below its 20-day moving average at 1,286 rupees, reflecting some near-term weakness. RSI analysis. The 14-day relative strength index currently stands at approximately 62.56, indicating neutral momentum, neither overbought nor oversold. This suggests the stock is in a wait-and-see mode, with technicals pointing to cautious optimism. Benjamin Graham valuation. For value investors following Benjamin Graham's principles, Dr. Reddy's presents an interesting case. The Graham number, which combines earnings per share and book value, currently stands at approximately $6.77 for the company's ADR. With the stock trading at around $14.38 ADR price, this gives us a price-to-Graham number ratio of 2.12. According to Graham's conservative approach, anything above the Graham number suggests the stock may be overvalued from a pure value perspective. However, it's worth noting that Graham's formula doesn't account for growth potential or intangible assets, both crucial factors in the modern pharmaceutical industry. Pros versus cons. Bull versus bear case. The bull case. Strong revenue growth of 17% CAGR with expanding global footprint across 76 countries, debt-free balance sheet providing financial flexibility and resilience, robust pipeline with 23 assets in preclinical and clinical development, particularly in oncology, strategic expansion into high-growth markets like weight loss medications across 87 countries. The bear case: ongoing regulatory challenges including FDA citations for manufacturing violations at multiple plants, significant tax demand of 2,396 crore rupees from Indian tax authorities related to past mergers, recent bans from China's drug procurement program following inspection failures. Stock appears overvalued from a traditional value investing perspective, important checks, scandals and global position. Dr. Reddy's hasn't been without controversy. The company faces ongoing scrutiny from the US Department of Justice and SEC over allegations of improper payments to healthcare professionals in Ukraine and other countries, an investigation that began in 2020 and continues today. Manufacturing quality has also been a persistent issue, with the FDA citing violations at biologics facilities in India and China, blacklisting the company from its drug procurement program until February 2026. Despite these challenges, Dr. Reddy's maintains a strong global position, ranking as the 47th largest pharmaceutical company worldwide with $3.35 billion in revenues, and holds the distinction of being among India's top 3 pharma companies. Conclusion: Dr. Reddy's Laboratories presents a compelling yet complex investment story. On one hand, you have robust financial performance, debt-free operations, and global expansion into high-growth therapeutic areas. On the other hand, regulatory challenges and quality control issues create genuine risks that investors cannot ignore. The stock appears technically neutral but fundamentally overvalued by traditional metrics, though growth prospects in emerging markets and biosimilars could justify the premium. As always, this analysis is for educational purposes only and should not be considered financial advice. Always conduct your own research and consult with financial professionals before making investment decisions. If you found this deep dive helpful, don't forget to subscribe for more comprehensive stock analyses. Stay informed, stay curious, and remember, in pharma investing, the devil is often in the regulatory details. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice.